School of Management Studies IGNOU presents an audiobook on the course MMPC 004 Accounting for Managers for MBA program. Presenting Block 5 Emerging Issues in Accounting, Unit 16 Forensic Accounting, Part 1.
After completing this unit, you would be able to understand the dynamics of fraud, understand the concept of fraud triangle, identify the potential frauds which can occur in various accounting cycles, classify the various frauds, and understand various forensic audit techniques. Introduction. The growth and development of accounting are linked to the growth and development of trade and commerce. A few centuries back, most of the trade and commerce were carried out by individuals with their own money and resources. As the volume of trade and commerce grew, there was a requirement for increased resources, both human resources and finance or capital. The proprietorship form of business gave way to partnership firms, which further transformed themselves into joint stock companies. In contrast to proprietorship or partnership firms, companies delegate the responsibility of running the business to managers with considerable autonomy to take transactional and strategic decisions. The overall supervision is done by the board of directors. This delegation of authority creates an agency cost problem. Agency cost is the internal cost arising from conflict of interest between the principal or shareholders and the agents or managers. It is hidden in the actions of managers or executives which are not aimed at maximizing the company's profit but rather enriching themselves at the cost of the company's assets. Agency cost can be reduced by the application of forensic accounting, as forensic accounting findings can be used to design the management and supervisory systems of the company, leading to effective monitoring. One distinctive feature of companies is that the funds invested in companies belong to a large number of people and financial institutions. Since the interest of a large number of people or stakeholders is tied to the company, it is but natural that the information provided by the companies is true and fair and reflective of the actual state of affairs. This information is provided in the form of the annual report and quarterly results. This information is compiled by the company by collating the information provided by the managers of various constituent divisions of the company. The verification of this information is carried out by both the internal and external auditors based on the documentary evidence and explanations provided by the concerned divisions. At this stage, certain irregularities can be detected. However, when irregularities are well planned, accounts are window dressed, and irregularities are carried out in collusion with executives and supervisory managers to cover the tracks, it becomes difficult to track them down. Sometimes these irregularities may be perpetuated by the promoters in collusion with senior managers, or even worse, collusion between senior managers, promoters, and auditors. Normal fraudulent activities can be uncovered through regular audits, but when fraudulent activities are complex, involving multiple accounts and divisions, the role of forensic accounting arises. Now let us briefly explain the concept of forensic accounting. Forensic accounting is a multidisciplinary activity involving accounting, auditing, computer forensics, investigation, and law. It involves gathering information and evidence which can withstand the scrutiny of a court of law. The scope of this unit is limited to the frauds committed in a corporate setting. Let us understand the meaning of occupational fraud. Occupational frauds are those in which an employee, manager, promoter, or owner of an organization commits fraud determinant to the organization. An overview of frauds. In order to get a general understanding of fraud, let us analyze the finding of the report to the Nations 2020 published by the Association of Certified Fraud Examiners. In this study, they examined 2,504 fraud cases from 125 countries. These fraud cases had caused a total loss of more than 3.6 billion US dollars. A typical fraud case lasts for 14 months before being detected and caused a loss of 8,300 US dollars per month. It is estimated that organizations lose 5% of revenues to fraud each year, with a median loss of 1,25,000 US dollars per case and an average loss of 15,09,000 US dollars per case. Asset misappropriation was the most common and least costly scheme, accounting for 86% of the cases and causing a median loss of 1 lakh US dollars. In contrast, financial statement fraud schemes are the least common and most expensive, accounting for 10% of the cases and causing a median loss of 9,54,000 US dollars. With regards to organizational preparedness, organizations with formal fraud awareness training for employees are most likely to gather tips through a formal reporting mechanism. 56% of organizations with formal training programs were able to gather fraud information through tips, in contrast to 37% of organizations without fraud awareness training. The use of anti-fraud controls has increased over the last decade, and lack of internal controls for nearly 1/3 of frauds. The presence of anti-fraud controls contributed to lower fraud losses and quicker detection of frauds. 43% of fraud schemes were detected by tips, and half of these tips came from employees. The preferred communication mode was telephone, hotline, and email, which were used by whistleblowers in 33% of the cases. Small businesses are now more prone to fraud risk than large organizations, as large organizations have well-defined structures coupled with structural rigidities and effective internal controls, which are largely absent in small organizations. The probability of certain frauds occurring in small business is high. That is, the probability of billing and payroll fraud is 2 times higher in smaller organizations, whereas the probability of check and payment tampering is 4 times higher. Concerning profile of fraudsters, men accounted for 72% of all occupational frauds, causing a median loss of 1,50,000 US dollars, whereas women employees accounted for 28% of frauds, causing a median loss of 85,000 US dollars. Owners or promoters committed only 20% of occupational frauds but caused a median loss of 6 lakh US dollars, whereas managers and employees caused a median loss of 1,50,000 US dollars and 60,000 US dollars respectively. 80% of fraudsters faced some disciplinary action in the past from victim organizations, and 46% of victim organizations did not pursue any legal remedies as they felt internal disciplinary action was sufficient to rectify the deviant behavior. 42% of fraudsters were living beyond their means, and 26% of them were facing some financial difficulties. Divisions more prone to fraud include operations, which account for 15% of frauds, while 14% of frauds originate in the accounting department. Executives and upper management accounts for 12% of frauds, and sales for 11% of frauds. Fraud triangle. In the context of forensic auditing, it would be worthwhile to discuss the concept of the fraud triangle. This concept identifies 3 categories of factors of risk that are present in the organization. These factors can potentially lead to fraud, or when a fraud occurs, these factors are present in the organization. These 3 factors are: number 1, Incentive and pressure, that is need. Number 2, opportunity. Number 3, rationalization and attitude. Now let us discuss these three factors briefly. Incentive and pressure. Management and employees are often put under pressure or offered incentives to achieve certain milestones which can be financial, operational, related to sales, cost, etc. These targets can be realistic or unrealistic. The problem arises when unrealistic targets are tied to remuneration and advancement opportunities. In order to achieve these unrealistic targets, the individuals, divisions, and company may have incentives to manipulate results or put pressure on others to do so. The company's pressure can also come from other stakeholders, viz., investors, banks, venture capitalists, governments, etc. The risk factors that may lead to fraud by companies are: Number 1. Situations that may threaten the financial stability or profitability of the company. Number 2. Pressure on management to meet the expectation of other stakeholders, especially that of investors and financial institutions. Number 3. Threat to the personal wealth of top management and promoters as a result of the performance. Number 4. Pressure on divisional managers by senior managers or board of directors. Number 5. Effort to maintain existing debt rating or move to higher debt rating order to raise more finance. And number 6. Inability to meet debt covenants or fulfill conditions in merger or acquisition agreements. Incentives and pressure can come in a variety of ways. Seen in the context of variable pay structure, where a large portion of remuneration is based on achievement of performance targets, there will be an incentive for employees and senior managers to mistake achievements if the target performance is not achieved. Another source of pressure is the practice of awarding stock options. The value of stock options is derived from stock prices, which are partly derived from company's performance. In order to protect the value of stock options awarded, employees have an incentive to paint a rosy picture of the company while the reality lies somewhere else. With reference to the risk of material misstatement due to misappropriation of assets, the risk factors are: Number 1. Personal financial problems, greed, dishonesty. No fear of being caught or punished may lead employees to commit fraud. And number 2. Adverse relationships with senior employees, dissatisfaction with organization or organizational policies, or a revengeful attitude might create a feeling of resentment and disloyalty, which may lead to fraudulent activities. Determining the presence and degree of these pressures or incentives and evaluating the risk that these variables possess in perpetuating fraud are the job of forensic auditors. Forensic accounting is used to quantify the losses due to fraud and trace the path through which fraud has been perpetuated. Opportunity. It is generally assumed that people are honest, but circumstances may exist or be created that may push employees or management to commit fraud. An opportunity must not exist to commit fraud, and these opportunities may come in the form of ineffective internal control, lack of supervision, non-segregation of duties, etc. Sometimes the organizational structure itself provides opportunity for fraud due to the nature, size, and structure of the business. By their inherent nature, some transactions are more prone to falsification or manipulation as compared to other transactions, as do certain kinds of balances or accounts. Similarly, certain types of assets are more prone to misappropriation. Various risk factors that are indicative of opportunities that could lead to fraud are: Number 1. Nature of industry in which company operates. Number 2. Nature of business transactions and the manner in which they are recorded. Number 3. Degree of dominance company enjoys over suppliers and customers. A high degree of dominance may create the opportunity for inappropriate or non-arm's length transaction. Number 4. Degree of subjectivity involved. The higher the subjectivity involved, greater the opportunity for deliberate manipulation. Number 5. The level of opportunity will also depend on the extent of supervision of senior management by the audit committee, non-executive and independent directors, and board of directors. Number 6. The complexity of the organizational structure and the stability of the company or group to which the company belongs. And number 7, the overall control environment, including the effectiveness of internal controls and information technology infrastructure. Rationalization and attitude. The propensity to commit fraud by individuals is a function of ethical values and personal circumstances. The external environment also plays a role in shaping attitude, especially during hard times. Management's attitude towards fraud tolerance also shapes individual attitudes towards fraud. Rationalization and attitude are intangible factors and by nature are difficult to observe and ascertain. Rationalization and attitude is a product of the culture of an organization and the psychology of those who work in it. Risk factors in this category are: Number 1. Lack of clarity about corporate ethical values. Number 2. Fraud risk is taken lightly and occurrence dealt ineffectively by management. Number 3. Budgeting and forecasting with large variance. Number 4. Management justifies inappropriate accounting and disclosure policies. And number 5. Non-cordial relationship with auditors. Most of the frauds begin on a smaller scale and grow in proportion over time. The typical rationalization arguments advanced by fraud perpetrators are: Number 1. It is just temporary and the manipulated entry would be reversed in the next quarter and there would be no material impact on the yearly results. Number 2. Management is indifferent towards frauds and it does not seriously monitor internal controls, nor it is proactive in correcting known lacunas in internal controls. Number 3. Management is hand in glove and expects and rewards this kind of behavior. And number 4. I deserve a better position and remuneration than offered by the company. The forensic audit shall try to find out whether such biases exist, and if such biases exist, then the company is a fit case for the occurrence of potential frauds. Before we move further, let us briefly discuss the major corporate frauds of the last 2 decades in India and around the world. We first start with corporate frauds in India and later on move to international corporate frauds. Major corporate frauds. Satyam Computer. It was one of the leading information technology companies of India. The promoters of the company devised ingenious ways to defraud the company and siphon off a large amount of money to the tune of $1 billion. The modus operandi was to issue dummy bills for services not actually rendered to foreign clients. The take proceeds were shown in bank accounts opened in various countries, and many of these bank accounts were either non-existent or the balances shown in them were highly inflated. In a nutshell, this fraud is comprised of 2 parts. One is showing inflated revenue and the second is showing inflated cash balances with the banks. Kingfisher Airlines. Kingfisher Airlines, after its establishment, developed as one of the finest airlines in the private sector in India, garnering the second highest market share after Jet Airways. The fall of the airlines started with the company borrowing huge funds from banks and related parties. The collateral for this borrowing was Kingfisher brand, an intangible asset. In India's financial history, it was probably the first time when banks had considered an intangible asset as collateral. When the promoters failed to pay back the principal amount and interest thereon, the brand value of Kingfisher took a nosedive and was virtually not of any value. The banks were saddled with NPAs of more than rupees 9,000 crores. Jet Airways. Jet Airways had the largest market share among the Indian airline operators with best-in-class services. However, its financial practices were questionable, which included number 1, overstating commissions paid to a related party based in Dubai, resulting in an overstatement of expenses and underreporting of profits. Number 2, diversion of funds by giving loans of around rupees 3,353 crores. And number 3, accounting of fake invoices. All this led to default in payment to lenders, vendors, employees, Airport Authority of India, and lessors of aircraft. The total liabilities on which it defaulted was rupees 25,000 crores, including rupees 8,500 crores to lenders. Bhushan Steel. It was a profitable company with a modern large-scale plants, but the promoters indulged in multiple fraudulent practices, which were number 1, transfer of borrowed funds to various related parties by way of loans and advances. Number 2, accounting for capital expenses that were never incurred and misappropriation of these funds. And number 3, the fraud amounted to rupees 50,000 crores, and investigation agencies have been able to establish that an amount of rupees 2,348 crores was diverted to more than 200 shell companies. PNB fraud. 2 diamond traders defrauded the PNB to the tune of rupees 16,000 crores. Both of them imported rough diamonds and exported polished diamonds. Their modus operandi was to open LCs of a large amount without any underlying transaction. This fraudulent practice did not come to light as these LCs were not recorded in the RTGS system of the bank and thus evaded the reconciliation process of matching LCs with the actual transaction. ILFS. This fraud was the largest corporate fraud in India and had the potential to destabilize the Indian financial system. It was the major vehicle for infrastructure development and finance. At the time the fraud was uncovered, ILFS had a debt exposure of rupees 91,000 crores, including rupees 20,000 crore invested as debt by PF and pension funds. The modus operandi used by the top management to perpetrate fraud consisted of many malpractices, which were number 1, diversion of funds to related entities of some members of top management. Number 2, lending to non-credit-worthy entities for consideration. Number 3, evergreening of loan by routing funds from one group company to another through or unrelated entity. Number 4, over-invoicing of projects by vendors, accounting for fake expenses and the difference routed back to related entities of top management. Number 5, overstatement of profits by non-provisioning for loans and inappropriate recognition of project revenues. Number 6, large number of subsidiaries and group companies numbering 346 which were used to route fraudulent transactions. And number 7, non-disclosure of group companies as related entity and non-disclosure of some of subsidiaries, associated and joint ventures. ILFS was enjoying the highest credit rating, which enabled it to issue a large amount of bonds to garner funds. Apart from these corporate frauds, there were a number of other corporate frauds in the last decade by companies like DHFL, PMC Bank, Yes Bank, Cafe Coffee Day, Spot Exchange of India, Ranbaxy, Quality Products, Amrapali, CG Consumers and Cox's and Kings. In all these cases, the mechanisms of committing fraud were more or less identical. Now let us briefly discuss a few of the international corporate frauds. Waste Management Inc. A publicly traded US waste management company reported over $1.7 billion in fake earnings. Enron Corporation scandal in 2001. Enron US Energy Commodities and Service Company had been using accounting loopholes to underreport billions of dollars of bad debts and simultaneously inflating its earnings. The uncovering of the scandal resulted in shareholders losing 74 billion US dollars as share price plunged from 90 US dollar to 1 US dollar in 1 year. WorldCom in 2002. An American telecommunication company had inflated its assets by 11 billion US dollars. The modus operandi was to underreport line cost and capitalizing on these costs instead of treating them as an expense. This fraud was uncovered by the company's internal audit department when it found out that almost 3.8 billion US dollars were diverted to unauthorized accounts. This fraud led to CEO being sentenced to 25 years in prison, loss of 30,000 jobs, and 180 billion US dollar losses to investors.
We were listening to the audiobook by the School of Management Studies IGNOU for MBA program course code MMPC 004 Accounting for Managers. Course Coordinator Professor Kamal Bagrecha, School of Management Studies IGNOU. Voiceover by Harpreet Kaur. Edited by Uday Sharma. Program assisted by Tarannum Jahan and Jagbandhu Jana. Program produced by Dr. Manoj Kumar Singh. This program was brought to you by Electronic Media Production Center of Indira Gandhi National Open University.